Welcome. Today's recording is all about balance sheets. A balance sheet is one of the two statements of financial position. Often in accounting, we're asked to look at statements of financial position, documents that look at the finances of a business, and there are two main ones we often consider. The profit and loss statement, which was covered in the previous video, as well as the balance sheets, which we'll be looking at today. So, what is a balance sheet? A balance sheet is very much a picture in time. Consider yourself taking out a camera, taking a photo of the finances of a business, and that is what a balance sheet is. There are three main things that it considers and looks at and includes. The first is all the things that the business owns. The second is what the business owes to other people or businesses or the government. And finally, it includes how much the business is worth to the owners. As you can see here, there is no discussion on a balance sheet of things like revenue, expenses, or profit. And that is true. They should never appear on a balance sheet because you've already dealt with them on the profit and loss account. So, a balance sheet is completely separate and looks at completely separate things. So, let's look at these three main sections. The first being the things that we own. On the balance sheet, we consider these assets. This is a word you need to get used to and associate in your mind to the items that the business owns. So, what might be some examples of assets? What might be some of the things that a business owns? You should be thinking of things such as maybe the building that they work in, assuming it's not rented, cars and vehicles, equipment, computers in their offices, money in their bank. It is technically owned by them, and so it is considered an asset. There are two main types of assets that we like to categorize them into. The first is something we call a current asset. Again, let's look at the words. Current generally means right now. Asset, we now know, means something that's owned by the business. So, a current asset is generally an item that we can turn into cash quickly or right now. Generally, it's less than 3 years, but we like to think of it as really quickly. If we needed cash to go and buy something or to pay a bill right now, could we get it? The other is our long-term assets or fixed assets. Again, the words fixed, they're staying put, asset, things that we owned. So these are items that will help us do business for a long time or will stay in our business. We will continue to own them for more than 3 years. So, if we look back at some of those examples, things like our building or our cars, we generally like to think we're going to keep those for a while, and so those are considered fixed assets. Things like the money in the bank or money that has yet to be collected or is owed to us by our customers could be things that we would consider current assets. Another major current asset would be your stock or your inventory, your items that you plan to sell. And hopefully you'll be selling those and turning them into cash in less than 3 years. So they would be considered current assets. Our second category are things that we owe, and we like to call those liabilities. If you think of the word liabilities, it comes from liable, things that we owe, money that the business owes. Some example, who might a business owe money to? The most common examples are going to be the bank in the form of a bank loan that we need to pay back or a mortgage that we need to pay back. Another very good example would be when we buy things from our suppliers, but we haven't yet paid them. They said, you know what, pay us in a month's time. And so we're kind of waiting to pay them. We owe them this money because we've already received our supplies, so it needs to be paid. Again, with liabilities, just like assets, we have two main categories, and you'll notice that they're quite similar. The first being current. Again, look at those words, current, right now, Liabilities, money we owe. So our current liabilities are going to be monies that we owe quickly or right now in less than a year. This would be where those monies that we owe suppliers would go. Our other example are what we call fixed liabilities. Fixed being around for a while. These are going to be the items that we're going to pay off over time that's more than a year. Most likely your bank loan and definitely your mortgage. And we've just talked about some examples. Our final category is going to be something that we kind of call what the business is worth to the owners. We call it our owner's capital. Okay? And this is money that the owners of the business, whether it's one person, whether it's a partnership and it's two-person, or if the company is a public company, this would be all of your shareholders, all the money they spent to buy the shares, the money that's been invested or tied up in the business. Included in this, if there's an investment made, if our owner puts more money into the business, if somebody buys the business, if another partner buys in, this would cause our owner's capital to go up. If the business makes a profit, remember, businesses are in business to make money for their owners. And so if there is a net profit at the end of the year, this money would go to the owners. And so it causes owner's capital to go up. However, if we give out a dividend, or if in an individually owned business, the owner goes in and takes money out of the till or out of the business, this would cause our owner's capital to go down because they've taken that money that the business technically owes them or it's worth to them out of the business, causing that owner's capital to go down. Also, owner's capital is one of the only items that continues from the last year. So when you go to do this section, you need to go and find last year's statement or the last statement that was done. Bring that over as your opening balance and then adjust it according to what's happened since then. So while everything else on the balance sheet is very much that picture of just what's happening right now, our owner's capital is something that needs to be calculated from the last time. And you'll see more of that when we do an example. So, why is it called a balance sheet? We know our profit and loss statement is called a profit and loss statement because it's a statement that tells us our profit and loss. Well, there's a good reason for the balance sheet as well. It's called a balance sheet because it must balance. Okay? All your assets, so all the things we own, minus all the things we owe or our liabilities, has to always equal our owner's capital. And if we think about this, this should make sense. We have all these things that we own that we could sell and get money for. We take out of that the money we owe somebody else, the things that don't belong to us, and what's left is really what the business is worth, what would go to the owners if we had to close up shop today and sell everything off. So when completing a balance sheet, we should always know by the end if we've done it correctly because they need to be the same. So it's almost time to make your own. Our balance sheets, just like our profit and loss, are always done in the exact same order. We always start by looking at our fixed assets, then our current assets, followed by our current liabilities, then our fixed liabilities, and then finally our owner's capital. There are a few calculations and specific lines that need to be included, but these will be covered in the next video where we actually go through and make our own. I hope you've enjoyed this presentation on the basics of a balance sheet, and as I said, if you'd like to see one in action being created, please join me for the next video.